This is a discussion of problem 4-14. The solution, the handwritten solution to problem 4-14 that I'm going to be discussing is posted on Blackboard. It's under the Jeter Chapter 4 content folder under the URL handwritten solution to P4-14. So the issue in P4-14 is when an acquisition occurs at a point in time other than the first day of the year. There's two methods of handling this. There's the partial year method and the full year method. The partial year method is really simple. The sub that was acquired closes its revenue and expense accounts to retained earnings on the date of the acquisition and starts out with clean balances, zero balances in the revenue and expense accounts post-acquisition, so that the consolidated income statement only shows the post-acquisition revenues and expenses of the sub for that first year in which the acquisition occurs. Under the full year method, it's a little more complex. The sub does not close their revenue and expense accounts on the acquisition date, and so at the end of the year, the consolidated income statement includes the sub's full year's revenue and expenses, not just the revenues and expenses that occur post-acquisition. So as a compensation, there is a subtraction on the consolidated income statement for the sub's pre-acquisition income. That is, the income earned by the sub before the acquisition occurred. The consolidated income is the same under either approach. The most common approach is the full year method, and that's what's being illustrated in problem 4-14. So here are the facts in problem 4-14. So we've got a company here, Punka Company. They bought an 85% stake in the sub Serrano Company. The purchase acquired on July 1st, 2010, and the consideration was paid in cash, and the 85% stake was purchased for $590,000. Now this is on July 1st, 2010. So here we are, December 31st, 2010, trial balance of the parent, trial balance of the sub. We're also told here that the sub declared a $50,000 cash dividend on December 20th, 2010 that's payable on July 10, 2011 to stockholders of record on December 31st, 2010. Punka Company recognized the dividend on its declaration date. The declaration date, of course, was December 20th, 2010. So at December 31st, 2010, the dividend payment had not yet occurred. There is a receivable sitting in Punka's books under current assets for the amount of dividend that is due them from Serrano Company, and there is a dividend payable account sitting on the liability of Serrano Company for the dividends that they have declared but have not yet paid. This is in the receivable in the parent company's books, and the payable in the sub's books represent intercompany accounts that we're going to have to eliminate as part of the consolidation worksheet entries. We're told here that the difference between book value of equity and imputed value of equity relates to sub's land that has appreciated in value, which is included in part of property, plant, and equipment here. So apparently this $750,000 in the sub's property, plant, and equipment is understated relative to market value because there is some land that has appreciated. Okay, so what we're asked to do here is to prepare the consolidated financial statements using the full year reporting alternative. Okay, so starting point, of course, is to prepare our usual schedule that we prepare at the time of an acquisition in order to compare the imputed value of the equity to the book value of equity, so we'll know what excess we have to assign to various accounts. So the facts of the problem tell us that the parent paid $590,000 cash for an 85% stake. So if $590,000 is what 85% of the equity is worth, 100% of the equity is worth $590 divided by 0.85, or $694,118. The difference between what the parent paid and the total value of the equity, the 114,118, that represents the value that we're going to assign to the non-controlling interest in equity. So we're going to have to report that on the consolidated balance sheet as a component of equity. Okay, from the imputed value of the equity, we subtract the book value of the equity to determine the excess of imputed value of equity over book value of equity, which has to then be allocated to accounts on the sub's balance sheet that have market value different than book value. In this case, there's only one, and that's the land. So the process of determining book value of equity here it differs in in two important material respects from what you've seen previously. We're still subtracting common stock, the equities, the sub's common stock, the sub's other contributed capital, the sub's retained earnings. We're still subtracting that stuff. And those numbers come right off the consolidated balance sheet here. So the sub here at the end of the year, common stock's 40,000. There's the 40,000. Other contributed capital is 40,000. Oh, sorry. Other contributed capital is 250,000. 250,000. Retained earnings 241. Yep, retained earnings 241. There's retained earnings of 241. Treasury stock. Serrano has treasury stock of 48,000. That's of course a negative component of stockholders' equity. We're going to subtract that out here. That's something that you haven't seen before, but it's a component of equity and needs to be considered when calculating the total book value of the sub's equity at the acquisition date. The one thing that's new here is this subtraction for the net income of the sub from the beginning of the year up through the acquisition date. So because the subsidiary company has not closed the revenues and expenses to retained earnings as of the acquisition date, the full book value of the equity cannot be garnered simply by looking at the balance sheet of the subsidiary company, because there is within revenues and expenses that were generated from the beginning of the year up through the acquisition date that eventually are going to make their way into retained earnings, but they haven't yet. So in calculating book value of equity, we need to take into account that income that is accrued from the beginning of the year, subs income that is accrued from the beginning of the year up through the acquisition date. So I'm going to show you where this 297,000 came from. Essentially, that $297,000 is the full 12-month income of the sub. We're going to prorate that for 6/12 of the year, or divide it by 2. And that $148,500 represents the income that has been generated by the sub from the beginning of the year up through the acquisition date. That needs to be included as a component of book value of equity in calculating the excess amount here. So total book value of equity, once we include all these things here, is $631,500. So the excess of imputed value over book value of equity, 62,618, is what we're going to allocate to the difference account and ultimately assign to subsidiary land. Okay, now I'm going to show you where this 297,000 comes from. So you go over to the worksheet, and the worksheet is in all the other cases. This simply drops in the information that's off the trial balance. So for example, we've got cash or current assets of $150,000 for the parent. There's cash of 100 or current assets of $150,000 for the parent. $180,000 current assets for the sub, $180,000 for the sub. So all these accounts over here were simply dropped over here in the consolidated worksheets, consolidated statement worksheet, which is arrayed in financial statement format. And the income number that I told you that I would tell you about, this $297,000 here, that represents the income of the sub here for the full 12 months. So if you take the revenues of the sub and subtract from the expenses, you come up with income of $297,000, which is what appears here. Half of that is the income that arose during the first 6 months of the year, which is what we're adjusting for here in our calculation of total book value of equity. Okay, so now that we've done that, we're ready to begin the process of preparing our consolidated worksheet entries. So here we've got the parent company is accounting for its investment under the cost method, so we're looking over here at the entries that we need to make under the cost method column. This first entry does not have to be made. It is not required in the first year under the cost method. It's only required in years 2 and later. So the first entry then that we need to make here is a consolidated entry in order to eliminate intercompany payment of dividends. So dividends here that were declared by the parent, or sorry, by the sub of $50,000 rather, and we've got an 85% stake in that sub, so 85% of 50,000 is the amount of the dividends that were received by the parent company. And the parent company, because they're under the cost method, recognize that the receipt of those dividends as dividend income, debit cash, credit dividend income. So what we need to do is we need to prepare a consolidating worksheet entry to eliminate the dividend income that's recognized here in the accounting records of the parent, and to essentially offset that against the dividends that are declared here on the subs accounting records. So we're offsetting this $42,500 against this $50,000, and that's what this first entry here does. The second entry is the entry to offset the equity accounts here of the sub against the investment account of the parent, and to establish the non-controlling interest in equity based upon our calculation here, which we said it was $104,118, and finally to recognize the difference between imputed value of the equity and total book value of equity. So the entry to do that is we're going to debit the sub's retained earnings for $241,000. There it is. We're going to debit the sub's common stock account for $40,000. There it is. We're going to debit the sub's other contributed capital here for $250,000. There it is. We're going to get rid of the treasury stock account, which has a normal balance of debit. So we're going to credit it here. The net income purchased, that's the amount that appears up here. It's the income that had been generated from 1/1 through the acquisition date. We are going to recognize that as a negative item on the consolidated income statement. The difference between imputed value and book value of equity, which we calculated above to be $62,618, we're going to recognize that here. The parent investment account of $590,000 here, we're going to get rid of by means of this credit. And then finally, again, the $104,118 non-controlling interest in equity that we calculated here, is going to be recognized by means of a credit here. So that is the entry that is made in order to eliminate the sub's equity accounts against the parent's investment account. So this was the first entry, this was the second entry, this is the one that we just discussed. The next entry is to allocate the excess of the imputed value of equity over book value of equity to the relevant assets and liability accounts. And that entry was made here. We're told here that this difference of 62,618 relates to appreciated land on the balance sheet of the sub. So we're going to take the balance in that account, credit it here to get rid of it, and transfer its balance over to property, plant, and equipment. The next entry to make is the entry to allocate the income that is accruing to the non-controlling interest. We're going to allocate that to non-controlling interest in equity. Okay, so we go down here and we look at the income of the sub. So the sub had income of $297,000. Of that $297,000, $148,500 arose from the beginning of the year to the acquisition date, and the other $148,500 arose from the acquisition date until the end of the year. It's the post-acquisition earnings of the sub that we need to prepare an adjusting journal entry for here, or a consolidated worksheet entry here in this step. So what we have to do is we have to calculate the earnings of the sub that arose after the acquisition date, multiply it times 15% because that's the interest that's owned by the non-controlling shareholders, and make the entry for that. So post-acquisition earnings, $148,500. That's calculated by taking the full earnings of the year and prorating it for 6/12 of the year, then multiplying that times 15%. Gives you $22,275. That's the earnings, the post-acquisition merger earnings that belong to the minority shareholders. We're going to debit an income statement account called non-controlling interest in income for that amount, and transfer an equal amount to non-controlling interest in equity. $22,275. The next step that we need to do, and the final step here, is that we need to allocate the dividends that were paid. Allocate the dividends that were paid to the non-controlling shareholders to the non-controlling interest in equity account. So if you look over here, you see that the sub paid dividends of $50,000. The sub paid dividends of $50,000. The minority shareholders received 15% of that, or $7,500. So the entry here to transfer the dividends that were declared, basically transfer a portion of this balance over to the equity section of the consolidated balance sheet in an account called non-controlling interest in equity. That's accomplished by this entry. And then one other thing that we have to do that is not described here is we have to eliminate any other intercompany accounts. And the one other intercompany account that we have is this corresponding dividend receivable here embedded in this $150,000 on the parent's books, and the corresponding dividend payable here embedded in the sub's liability account. The amount that represents intercompany is 85% of $15,000, or $42,500. So we need to offset $42,500 of this dividend payable against current assets here. So the entry to do that: debit dividend payable $42,500, credit current assets $42,500. So I think that we discussed all the entries, consolidated worksheet entries that we need to make here. The only thing that differs between this problem and the very first problem that we worked before spring break, which I think was exercise problem 4-8, the only significant difference is that we've got this one item. The acquisition did not occur at the beginning of the year, therefore we had to take into account the income that arose from the beginning of the year up through the acquisition date in the calculation of book value of equity, which in turn is manifested as part of the entry that's made to eliminate the investment account against equity. So if you post all these entries into the consolidating worksheet, by the way, this one does show, if you foot down here, there's the total debits. If you foot down here, here's the total credits. Okay, so I posted all the entries here that you just saw on the entry page, and here are the consolidated financial statements. Notice here that this consolidated net income number here represents 100% of the sub's revenues and expenses, and 100% of the parent company's revenues and expenses. So that gives you this consolidated net income number. From that, we subtract the net income of the sub that arose prior to the acquisition date. That was 1/2 of the $297,000. That's being subtracted here, and then we're, as usual, subtracting the non-controlling interest share of the post-acquisition earnings of the sub to yield the bottom line net income that rolls over to retained earnings down here. So I don't think there's anything else significant and noteworthy to talk about in the extending of the footings on the eliminating entries, extending those over to the final consolidated balances. Really the only unusual hook here in this problem was the fact that the acquisition did not occur at the beginning of the year, necessitating that we have a subtraction item here on the consolidated income statement to subtract out the net income that was purchased. So this reflects an acquisition that did not occur at the beginning of the year, and it is the full year reporting alternative in the sense that the sub did not close out its revenues and expenses at the on the acquisition date.